Welcome back to Bonnie's Life, where we cut through the noise to bring you the unvarnished truth about the global financial markets. Over the past 24 hours, the crypto market has experienced a seismic shift, with Bitcoin plunging below $77,000 and the total market capitalization shedding 3.8% to land at $2.56 trillion. This wasn't just a random dip, it was a calculated market reaction to escalating geopolitical tensions, specifically President Trump's stark warning to Iran that the clock is ticking. This rhetoric sent Brent crude oil soaring past $112 a barrel and triggered a massive $660 million liquidation cascade across the crypto space, wiping out over $592 million in leverage long positions in a matter of hours. As Tom Lee of Fundstrat astutely pointed out, Ethereum's inverse correlation to oil is currently at an all-time high, making rising energy prices the biggest headwind for the crypto market right now. We are seeing a classic risk-off environment where macroeconomic fears are overriding fundamental crypto developments, leaving retail traders caught in the crossfire while institutional players quietly reposition. Beneath the surface of these geopolitical tremors, the macroeconomic data is painting a deeply concerning picture that mainstream media is largely glossing over. The latest U.S. inflation data for April came in hot at 3.8%, the highest in nearly 3 years, while the producer price index surged by a staggering 6% year over year. This persistent inflation has completely derailed the narrative of imminent rate cuts. Jeffrey Gundlach, the double-line CEO known as the Bond King, stated unequivocally that it is just not possible for the Fed to cut rates in this environment, and the odds-on bet is that their next move will actually be a hike. This sentiment is echoed by the rising probability of a rate hike in 2026, which has now jumped to 40%. The confirmation of Kevin Warsh as the new Fed chair only adds to the hawkish outlook. This macroeconomic pressure is causing institutional capital to flee risk assets, evidenced by the massive $1.25 billion in outflows from Bitcoin and Ethereum ETFs this week, snapping a 6-week inflow streak. Even major players like Goldman Sachs have completely exited their $154 million XRP and Solana ETF positions, signaling a strategic retreat to safer havens. However, if we look beyond the immediate panic, there are fascinating undercurrents and hidden developments that demand our attention. While retail investors are panicking, Strategy, formerly MicroStrategy, quietly executed a mammoth $2 billion purchase, acquiring 24,869 Bitcoin at an average price of $80,985, bringing their total treasury to an astounding 843,738 BTC. This massive accumulation by a corporate giant suggests a long-term conviction that ignores short-term volatility. Furthermore, we must pay attention to the technological arms race happening in the background. Citi Research recently issued a stark warning about the accelerating breakthroughs in quantum computing, estimating that up to 6.9 million Bitcoin, about a third of the circulating supply, are at risk from harvest now, decrypt later attacks. On the flip side, Ethereum co-founder Vitalik Buterin has highlighted how AI formal verification could revolutionize smart contract security, a crucial development given the recent $11.58 million hack of the Verus Ethereum bridge. These technological shifts, combined with the regulatory anticipation surrounding the Clarity Act, which Rick Edelman predicts could send Bitcoin to new all-time highs once signed, indicate that the true value drivers of crypto are evolving rapidly. So, how do we navigate this treacherous landscape over the next 24 hours? From a technical perspective, Bitcoin is currently testing a critical support zone around $77,000, having fallen out of its descending channel and failing to reclaim the 200-day moving average at $82,455. The daily chart shows a clear bear flag pattern, and the weekly candle opened with a bearish fakeout below the major $80,600 resistance. However, the stochastic RSI indicators across the 4-hour and daily timeframes are in extreme oversold territory, with the 4-hour RSI hitting 30, right in the middle of the $74,000 to $76,000 institutional demand zone. This suggests that the selling pressure may be nearing exhaustion. The strategy for the next 24 hours is to look for a relief bounce. If Bitcoin can hold the $76,500 level, we could see a pushback up to test the bottom of the broken channel around $79,000. However, overhead resistance is immense. Traders should set tight stop losses just below $74,900. As a break there could trigger a rapid descent to the $67,000 macro support level. In conclusion, the next 24 hours require extreme caution and tactical precision. Do not get caught up in the emotional whirlwind of geopolitical headlines or the despair of liquidations. Instead, focus on the data. The oversold technical indicators suggest a short-term bounce, but the macroeconomic reality of sticky inflation and potential rate hikes dictates a defensive posture. If you are trading, look for quick scalp opportunities on the long side if support holds, but be ready to flip short if we see a weak rejection at the $79,000 to $80,600 resistance cluster. Keep a close eye on oil prices and the bond market, as they are currently the tail wagging the crypto dog. Remember, in markets like this, capital preservation is just as important as capital appreciation. Stay sharp, stay informed, and don't let the mainstream narrative dictate your trades. Until next time, this is Boni signing off.